Good morning and welcome to today's webinar about the VSV-ASG Investment Pulse 2025 survey, live from our studio here in Zurich. My name is Abdullah Mohamed. I'm a sales executive at Vanguard here in Zurich, and it is my pleasure to be your host today. Joining me are our two experts, Professor Dr. Manfred Stüttgen from the University of Applied Sciences, Lucerne. Good morning, Manfred.
Hello, Abdullah.
And Oliver Maas, Head of Global Activities from the Association of Independent Wealth Managers in Switzerland. Good morning, Oliver.
Morning, Abdullah. Thank you for inviting me.
Thank you for being here and taking us through the exciting results of this study. We've been running this study for the fourth consecutive year. The exact timeline was end of February 2025 until end of March. And before we dive into the results, I would like to let the audience know that you can address your questions via the Q&A box, and that we'll be discussing them at the end of this webinar. And also, should you experience any technical issue, simply refresh your browser. That should be solving most of the issues appearing. Without further ado, let's dive into the results. Manfred, could you take us through the sample size and the setup of the study?
Yeah, absolutely. First of all, I'd like to thank all the independent wealth managers who have been so kind to participate in this survey. This year, there have been 163 wealth managers, which is pretty much in line with last year's survey. We have the hidden assumption that some of them might be kind of recurring participants, so maybe that's the same sample that we already had last year. And let me sum up how we set this study up. What you see on the slide on the left hand in the circle, if you read this clockwise from 12, we have approximately a quarter of wealth managers, 8% plus 15%, who are smaller than 100 million assets under management. Then we have another approximately third of the participants, 15% plus 18%, who are between 100 and 400 million. And then the remainder, which is the biggest chunk, almost half of them, or 46% in total, are bigger than 400 million assets under management. Overall, that's a very nice sample, and it gives us a very good overview of the industry, because the industry as of May is made up by approximately 1,300 wealth managers who are registered with the FINMA. If you look at the right hand of the slide, you see a map where we have depicted the end client domicile of the participants, or of the clients of our wealth managers who participated. And as you can see, almost half of them, 48%, of the end clients have their domicile in Switzerland, 35% in Europe, and the remainder are all over the world in North America, South America, Asia, and Africa, between 2 and 4%. That's the regional coverage of the end clients to keep in mind. We've also looked into the product offering. We've asked them, the wealth managers, for the split of their offerings. And we have like a sort of 80-20 rule here. 81% of their business is focused on discretionary mandates. 19% is focused on advisory services, or you could say, well, the revenues come from advisory services. So that's the picture there. What you do not see on this slide, we also looked into the clientele. So are they more private clients or are they more institutional? And it's a bit more than 90% of those 163 wealth managers who have private clients who they serve, and approximately a little bit more of 70% who serve institutional clients. So many of them will probably serve both institutional clients, a little bit less than private clients, which I think is very much in line with what the business looks like.
Quite a broad sample of independent wealth managers. Oliver, if you look at the sample size, does that align with your members or what you see in the market?
Yeah, first of all, also, I would like to thank all the wealth managers who actually participated in that study to make it representative. I think, as a matter of fact, it is. Although I think there's a slide all the way to the larger ones, as we already had last year as well. So if you look at the figures we have and the press release of FINMA, probably the ratio between large and small is different in that the smaller are a big proportion, over 50%. Irrespective of that, I actually like this distribution because it's representative in a sense that we have all sizes represented in that study. So I would say, yeah, it's a very useful and representative distribution across the wealth managers.
Excellent. And in the study, we do ask our audience some static questions, right, about their asset allocation, product preferences, or ESG implementation, but also some questions that are changing from year to year. And in this year's survey, we have had a change actually. We asked our audience, how do they generate alpha? Which strategies do they follow? Manfred, please take us through the interesting results that we got here.
Yeah, this is sort of the question for the holy grail of wealth management. Where do you find alpha? And what we saw here is that wealth managers in Switzerland have a very clear preference for strategic positioning over short-term tactical moves, which is a sign of their professional behavior. So we're not surprised to see this, but it's good to reconfirm that. Very much a strategic view. And if you look at the list of the different strategies, out of 8 strategies, they could pick the top 5 strategies that they prefer to produce like a good and outperformance. And what you see here is that the strategic asset allocation has been voted by 81% as one of their top 5 strategies. Only 19% didn't include it in their top 5s. So that is strategic asset allocation is very important, by far the most important lever, followed closely by single security selection, be it stock picking or bond picking. That is also a very prominent strategy to create performance. If you look at the next 2 levers, thematic investments and rebalancing, they're also very important. Tilting portfolios towards specific regions or sectors a little bit less so, but all 3 would say, well, they're reasonably well represented here. What we see, however, and you do not see this on this slide, we had another breakdown here. We saw that thematic investments is more prominent with smaller wealth managers. 51% of them have it in their top 5 priorities, while with the larger ones, it's only 42%. So differences depending on the size of the wealth manager, and the cut between small and large is approximately 200 million assets under management. Quite the other way around, tilting portfolios towards specific regions or sectors, that is more often preferred by larger wealth managers and a little bit less often by smaller ones. So 40% of the larger ones have this in their top 5 priorities and only 30% of the smaller ones. Less interesting from the point of view of wealth managers to create alpha is market timing, a more tactical move. They also, at the bottom of the list, you see this, they less often use like hedging strategies or currency for foreign exchange hedging to create performance. And also in the least 3 preferred strategies is interacting with clients in turbulent times, which is something I'm sure we've seen a lot early in April, but that's a different story.
And also the time frame is different, right? We've conducted this study actually from end of February till the end of March. But if the Swiss wealth managers, the audience would like to compare these results with the wealth managers in the United States, Vanguard has an own paper, own research on this called Advisors Alpha, where we quantify the added value of an advisor. And there you can compare the Swiss results to the ones in the United States. Now, Strategic asset allocation is a main lever, you said, to generate alpha. If we look at the asset allocation across equities and bonds, how did these shift from the last year's weightings?
Yeah, let's have a look at equities and bonds. First thing is, what does it look like? And then the second step is kind of how did it shift compared to last year? The key message here is pretty simple. If you look at equities, you see that Swiss and European equities are overweighted. But maybe I introduce first how you read this chart. You have on the left-hand side an underweight, on the right-hand side of the vertical bar an overweight. We count the wealth managers, so this is not weighted assets. That is something important to keep in mind. We count the asset managers or the wealth managers, and we see the amber bullet is 2025 compared to the blue bullet 2024. You see, as I said, Swiss equities are overweighted, and we see a continuity in this. So it was the same last year and the year before, even if this year there was a slight uptick, so a slight shift to a slightly stronger, even if still a mild preference on overweighting Swiss equities. European equities, the same thing. You see that they are slightly overweighted, but there has been a shift from underweight to overweight. And while we've doing the studies during the last 3-4 years, this is the first time, I wouldn't say in inverted commas in history, in our small little history, that Europe has been overweighted. The US is a bit of a different story. They had been slightly overweighted last year, and they've come down to a balanced position. And as you said already, this picture is a snapshot made in February, March. So that has been taken prior to the April turbulences in the markets. What you see continuously so is a slight underweight in the emerging markets and the Asia Pacific, including Japan, and there have been rarely any shifts. So there is a lot of continuity in a slight underweight with regard to these markets on the equity side. If you look at the lower part of this slide, where you see the investments in government bonds, corporate bonds, and high yield emerging markets bonds, the picture is very straightforward. There is usually an underweight of the bonds, with two exceptions, the European and the US corporate bonds. And basically, there are some minor shifts. If I wanted to pull out two shifts, you look at the Swiss corporates. They have been slightly underweighted, while the emerging markets and the high yield bonds have seen a slight shift from a bit more underweighted to a bit less underweighted. So it's going a little bit into the balanced direction with the emerging markets and the high yield bonds.
Very interesting to see. Maybe let's go one layer further. How did Swiss wealth managers implement these asset allocation strategies in their portfolio? Did they use single securities or actually third-party products?
Well, the answer is they usually do both, or most of them do practically both, but it depends a bit on kind of the equity or fixed income perspective and also on the regional perspective. Here again, you see the direct investments on the left-hand side of the vertical bar and the ETFs and the funds on the right-hand side of the bar. And you see that Swiss equities are typically directly invested. So wealth managers have a slight preference for direct investments for Swiss equities. They know the companies very well. There is a slight home bias, but also, I assume, but we haven't asked for that, there's also, we have a strong currency in Switzerland. You don't have any currency risks in there. So direct investments in Switzerland, but on all the other regions, on the equity side, you have a slight preference or even a strong preference to implement the portfolio through funds and ETFs. So when you look at Europe, it is almost balanced, a slight shift towards using more products or funds, ETFs, emerging markets, the US, the same thing, slight preference for funds ETFs and a slight uptick. A strong preference to implement emerging markets and Asia Pacific, including Japan, through funds and ETFs, even if slightly less so, but I wouldn't overemphasize these minor shifts. If you look at the bond side, the picture is a bit different. There is, for most of the different regions, you have wealth managers implement them directly. It is correct for government bonds, Swiss, European, and US, but also for corporate bonds, be it Swiss, European, or US. All of them are directly invested, more often than not, but there is a tendency towards like a more balanced investment in the direction of using funds as well. When it comes to emerging markets bonds and high yield bonds, the picture is basically unchanged. There is a stronger preference to use wrappers like funds and ETFs to implement those asset classes.
You've said that they're using both channels, basically single securities and also third parties. And in this year's edition, we've asked a particular question about the product selection criteria of the wealth managers. Could you maybe also take us through the top criteria that wealth managers are considering when it comes to selecting a third-party product?
Yes, that is another interesting question and answer. And basically this question has been answered only by those wealth managers who use funds, but this is basically 90-95%, so 151 wealth managers have answered this question. And what we see here, the top three are liquidity, historical track record, and fees and taxes. These are the number one criteria, sort of hard fact product focused. They obviously love it when the products are flexible and tradable. When they are traded at stock exchanges, that implies also they have lower spreads. So 64% list liquidity in their top five priorities. Historical track record, proven performance, that's another criterion listed by 60% of the wealth managers, and then fees and tax by 56%. So these are the top priorities. If you go down further on the list, maybe not in the order of the list here, but I would bucket like the current financial performance, the benchmark comparisons, and the specific risk measures as more trackable hard figures. They, interestingly, rank a little bit lower on wealth managers' priority list when selecting funds, but also, and that is interesting as well, more the criteria that are more related to the fund provider, the teams who manage the funds. So investment philosophy, 46%, experience, expertise of the investment manager and the team, 39%, and right at the bottom, only 15% have the fund provider's brand strength and resources as their top five. And I think that struck me a bit, that like the selection criteria focus more on the products, they're tangible, they're hard criteria, than on the team and the fund provider. However, we saw some differences again, which you do not see here on this slide. If you compare the larger ones with the smaller ones, the wealth managers. So the larger ones rank fees and taxes even higher, 61% have it in their top five. The smaller ones, only 47%. And the same thing with investment philosophy and process. Here again, the larger ones have it more often in their top five priority list, that is 53%, and only 36% rank this in the top 5 out of 10.
Thank you very much for the results. Oliver, the association has a lot of members, a lot of Swiss wealth managers, small ones, large ones. If you look at these results, do you think they're aligned with what you're hearing in your conversations, or is there anything that actually surprises you?
I'm not surprised by the first three, to be quite honest. I'm more surprised about the last one, or the one that ranks last, i.e. the fund provider. were actually until now aware that the brand was actually an important criteria for choosing a fund and bring that into your portfolio. Potentially that goes along with liquidity, because the bigger the brand, the more liquidity you usually have. But yeah, that came as a surprise. We're unbiased, but it came as a surprise for me personally. And also, but probably we just were too early in the game. The question about the risk, specific risk measures within a fund, given the circular FINMA, whereby you have certain exclusions that you can make on bulk risks in your portfolio when you choose a fund with the right risk diversification. I probably would have guessed that would have been a bit higher, but probably we're just also here a little bit early in the game, and that might change in the future. But other than that, yeah, I think it's a very representative result.
Thank you for your inputs. Now, looking at the external or third-party products, right? You have actively managed products, but also passively managed products. And we've also asked our audience which ones they're using in which asset classes. Manfred, please give us the results of the...
Yeah, sure. I mean, wealth managers maintain a preference for active or sort of balanced strategies when investing in equities. So you can see this here for Swiss and European equities, a slight preference. US is sort of in the middle. There is a stronger preference for passive investments when it comes to emerging markets and Asia Pacific, including Japan, on the equity side. And you have rarely any shifts compared to last year. So that is almost very stable. On the bond side, you have a bit of a different picture. More often than not, they tend to prefer passive investments. And there is a shift or smaller shifts here and there also towards implementing bonds more passively. Yeah, you see it on the government bond side in particular, but a bit also on the emerging markets. For European corporate, US corporate, you see a slight preference for active, but I mean, the differences are small here. I mean, we have 160 people approximately who answer the question. So if there's one or two who answer differently, then you're already oscillating at this vertical bar.
So no major shifts here, but if we zoom out a little bit, we can see that there are quite a few dots on the passive side. Mm-hmm. And also there you have different implementation wrappers, so to say. You have the index funds, you have the ETFs. What are the product or wrapper preferences of Swiss wealth managers, Manfred?
I mean, they're very clear, focusing on ETF in particular. The question we asked, do you use ETF only? Do you use index fund only? Or do you use both? And on this chart, the green or petrol color shows that on the equity side, ETF only is the predominant strategy to implement passive investments. While the ETF only, the amber bars on the upper side here, they have come down, they are in the minority, and they also have come down a bit from 10 to 7%. Many of the wealth managers use both ETFs and index funds to implement equities, and the shifts are minor. Yeah, I would say this is a very stable picture, and ETFs are dominating this picture. With bonds, it's a bit of the same pattern, even if it's not exactly the same figures, but here again, ETFs dominate on the bond side. ETF only, a bit less so than last year, so it has come down a little bit from 49% ETF only users to implement passive investments to 43%. And at the same time, the index fund only users have only come down a bit from 17 to 15%. So the bar that depicts those wealth managers who use both ETF and index, that has grown from 34 to 42%, which means they are becoming a little bit more flexible and pragmatic in using both of these vehicles to implement their portfolios.
Thank you, Manfred. Before we now move to the last questions or last results of the survey, I would like to remind the audience that you can place your questions in the Q&A box and that we'll be receiving them live here in the studio and addressing them shortly towards the end of the webinar. One additional question that is also very popular and that has been steady throughout the 4 editions was the topic of ESG implementation, Manfred. How has that picture evolved?
Yeah, sustainability in investing is always a topic. I think it has grown out of a niche into a real segment. What we see here on this picture is that we have asked for 3 different categories of users or non-users of ESG strategies. We have the green bar, 2023, 24, 25, of the users who say, yes, we always include sustainability criteria in our investment processes. And that bar has come down a little bit by 5 percentage points year on year. So from 23 to 24, 5 percentage points down and another 5 percentage points down. The wealth managers who say, yes, we do implement, we include sustainability criteria in our investment processes. If the clients ask for it, that's a very stable percentage. It has been 43% in 23, 48 in 24, and 45 in 25. So if you add up the yes, we do it always, plus yes, we do it on request, you have still a stable approximately 60%. If you focus only on the amber part of these bars, you say, well, there's 1/3, 32% in 23 and 24 who say, no, we don't use these criteria or strategies. That has grown a bit. The question is, how do you interpret such a chart? I mean, we are doing other studies on sustainability. We know that the market has grown for a couple of years, year after year, and now in the last year or 2 we have some headwinds which are mirrored a bit in this picture. We know or emphasize this. We think still this is a structural upward trend, but here we see that in the last 1 to 3 years that has something to do also with the crisis in the Ukraine, where oil prices have fluctuated, investments in raw materials have been seen, interests, and that has affected also the affinity and the preference for sustainability criteria. But what we also have to keep in mind when we interpret this picture is that many of the wealth managers do stock or bond picking, and it's always not that easy to really implement sustainability criteria with all the data and the expertise that you need. In one of our previous studies, we asked the wealth managers in this survey here what the barriers were, and some of them said there is a lack of standards and data, maybe also lack of in-house expertise and resources, and a couple of other criteria that is still a little bit of a barrier for those small firms to really hop on this trend or structural trend.
But as you said, the majority still offers it to their clients. And actually, Oliver, do you see the same picture or a similar picture when you speak to your members?
Yeah, definitely. I think it's not a question. I think it's more than a trend. I think it's here and it stays. It's a political-driven initiative also. Let's not forget that. I think it, as usual, it first is addressing the institutional wealth management side, and then probably filters down to the independent wealth managers. It reflects very much what we also see. I mean, I said that last year, I said that the year before. It's very much driven by the client side. So where client demand is there for ESG-related products, there is an offering with the wealth managers. There are some who clearly, I also said that last year, clearly don't do it because they think it's not serious to offer it because they don't have neither the system nor the processes, because it's about an investment process, as we said. So they have not implemented a respective investment process, so they basically don't offer it. whether that in itself means that the portfolio is not ESG compliant is a totally different issue. We're asking, do they systematically implement that? It might well be that the portfolios actually have a higher percentage of ESG compliance than is reflected through the systematic investment process. So yes, it is also representative. It's what we see, but it's definitely a topic that is present in the wealth management industry in Switzerland.
Yeah, and you could also, if I may add on your comment, many of the wealth managers are having a home bias on Swiss equities, and most of these Swiss equities, maybe there's one or two exceptions where you could have a debate, but many of them are very well rated. So if you have a bias towards Swiss equities, you already have pretty much of a sustainable portfolio when it comes to the equity Swiss side, at least. The other thing, we do other studies, I and my team, we do other studies, and we see that on the fund side, it's always the same picture. It's like 20 to 25% of assets or the number of funds who are sustainable. I would say it's pretty much in line. There they continue to grow. The growth has come down a bit, but I would say it's pretty, you can align it with the numbers in this study here as well.
You've mentioned the product side, Manfred. There are many ways to implement ESG. How did this picture change or evolve from the previous year's study? Or a different question, what are the top strategies that independent wealth managers are using to implement ESG in their portfolios?
Yeah, basically this question has been answered by only those wealth managers who either use ESG criteria always or on client request. And those who do it always, they use on average 3.3 strategies to implement sustainable portfolios. Those who do it on client requests, slightly less so, they use like 1.8 different strategies to implement the portfolios. And what you see here on this slide is, it's a bit tricky to read. If you read it from the left, you should have a look at the average percentage numbers on top of the bars. They are the average of those who do it always and those who do it on request. So if you read it from left to right, you see 43% vote for best-in-class and positive selection as their most preferred strategy to implement sustainable portfolios, followed closely by ESG integration, and then 35% use exclusion based on negative screening. So these are the top three priorities. They differ a bit between those who do it always, which is the green bar. Their best in class is the most preferred with 63%. Those who say yes if requested, they also love best in class more than all the other strategies with 37%. Very closely followed, ESG integration is even higher with those who always implement ESG strategies, 67%. ESG integration is slightly less preferred by those who do it on client requests. And then a little bit less interest on the exclusion-based or the negative screening. But all in all, these top three strategies are sort of stable in the top three, but the order has changed a little bit. So last year, I think best in class was on the second place, while ESG integration was a little bit higher. Slight differences here and there. But overall, these are the top three strategies. The least preferred strategies, if you read it from the right, are engagement and voting, a climate strategy in the portfolio, so you fiddle around with metrics like carbon emissions in your portfolio or your investments, or impact investing. So these three strategies, both for those who always implement ESG criteria, but also for those who do it only on client requests, they rank lower. And that is pretty much also in line with what we've seen in the previous years. Thematic investments is a little bit of a different story. This is interesting because, well, it's still somewhere in the middle, like 46% of those who always do it have it in their priority list. But what you don't see here is small wealth managers prefer thematic or sustainable thematic investments more so than larger ones. Other than that, we don't see very many differences between the smaller ones and the larger ones.
Thank you very much for the results. And with that said, I think we can start the question and answer session. So I actually received some live questions here in the studio. One of our audience members asked if we basically have data on companies that have investment committees in our study, and if not, how, if we could give an estimate, basically, probably addressed to you, Oliver, how many companies do have an IC, and what the composition of such an IC could be?
It would be nice to have a study. It was not in this study, and not that I recall, and we don't have a respective study, but that would materialize. I could give you statistics, but by experience, probably the larger ones might have. I'm pretty sure they have an investment committee, but we did not really have a representative idea of on how much the influence of that investment committee was to the study. I think that was the question.
Yes.
So we cannot say. I can say yes, probably within that larger group of 200, probably not 200, but 500 million plus. These will have an investment committee. How much investment committee was taking part in filling out that study? I have my doubts. Probably it's the CIO who did, but based on the house view of the respective wealth manager. So I would gladly give any house numbers here, but we don't have a study, and we for sure didn't implement it in that study.
But I mean, I could comment on this one as well. We don't know is the answer. We didn't ask the question. We don't know. So these are some speculations here that we could add. But I'm looking at the sample again, and I presented the size measured by assets under management, but we also looked into the size by the number of full-time employees. Mm-hmm. And in our sample, it is approximately a little bit more than 40% who have more than 6 employees. Yes, so that means like approximately 60% with less than 6 employees. Now you can count how big such an investment committee can be if you are in the smaller part of the sample size. Yeah, we have a quarter approximately of the wealth managers who have more than 10 employees. Yeah, and I would assume then it starts making more sense to have a subgroup who is the investment committee. If you're only 3 or 4 or 5 people, well,
then it's a different picture. Thank you very much.
It's really that would be speculation to give you any numbers on that one.
Perfect. Another question that I see is actually the strategies to generate alpha. Maybe for you, Oliver, what is the view of the members? Do you see an alignment there? If we look at the chart,
let me go to the chart. Sorry, yes. I have probably that's my age, a short-term memory. But if I recall correctly, I mean, I'm happy about, or also not surprised by the first 3 ones. So SAA and selection of securities, as well as thematic investments, which is actually nicely in line. It's a general trend, the small ones, and we saw it's also makes me happy because it shows the representativeness that we have the same bias then on the ESG as we just heard. So it's a general perception on how to invest is to invest thematically in the smaller mid wealth management. But that's not a surprise, as I said. Now let's go to what is a little more a surprise to me, but probably that has to do with when we did the study. So the interaction with clients, that it's lower rated, that might have been different if you would have performed the study in April, I would guess. and also market timing. I would be different in, let's call it, post-tariff noise. Probably that would shift also now that we probably enter in a phase where we have to get accustomed that we do SAA, but we need to make tactical shifts given that, well, we probably have to think now in 30 days, 60 days, 90 days periods that might shift. But I'm happy about the chart, and it also reflects, I think, and rightfully reflects how wealth managers want to generate alpha in the market environment.
Maybe before we're up on time, one last question that I can see. Manfred, probably one for you. How do you see the ESG trend?
Well, overall, I would say it's probably more short-term than long-term. Yeah, that's my personal view. I do lots of studies on ESG, and I see in Switzerland, outside of the independent wealth managers, that the topic still is picking up, like with the private banks and the retail banks, which are sort of peers of the independent wealth managers. It's still growing, even if the growth rates are coming down. But yes, we have seen headwinds during the last 1, 2, 3 years. Some of them had to do with like the war in the Ukraine, which I mentioned. Also some political tendencies. The US administration has having its vote on topics like climate and others. But in Europe, my personal conviction, it is a strong topic here to stay. And I wouldn't be surprised if in the future the picture changed again, also for the independent wealth managers, particularly when they cater to the needs of younger generations, or maybe more female clients, where we know from other research that there is an interest in Switzerland. From various studies, we've learned that it's approximately 50-50 with investors on the private client side when it comes to their interest in sustainable investing.
So it will be interesting to see when we sit in the studio in 1 year's time how the trends have evolved. Manfred, what are the key takeaways of today's webinar and this year's survey?
Yeah, if I had to just wrap up briefly, I would say the strategies to generate alpha to keep in mind. This is more strategic than tactical, what the wealth managers do. It is about the strategic asset allocation and also about single security selection. These are their favorite ways to produce performance or outperformance. The second key message is around asset allocation. Equities are overweighted. I mean, that plays into the first bullet, like strategies to generate alpha. Well, at least in Switzerland, if you look Switzerland only, on the one side, there is not much of a yield to gain. But equities are overweighted by the independent wealth managers, Swiss and European equities in particular, and they have been slightly increased. And then, last but not least, how do wealth managers in Switzerland implement their portfolios? There is a steady preference for direct investments on the bond side, but also on the Swiss equity side. And on other assets like equities outside of Switzerland, there is a preference, slight or strong, on using certain products like funds, be it active or passive.
Thanks for wrapping it up, Manfred. For the audience, in case you would like to watch the replay, you'll be getting an email after our webinar with the replay link, but also with the study booklet where you can go through the results. If you have any questions, feel free to reach out to us. And also on behalf of Vanguard, I would like to thank all the independent wealth managers that participated in this study and made it actually happen, and also to our audience that tuned in for today's webinar. Thank you very much, Oliver, for your insightful inputs, and thank you, Manfred, for taking us through the study results and doing actually the academic research.
Thanks for having me.
With that said, we're saying goodbye. Thank you for joining in, and we'll see you in a year's time. Thank you. Bye-bye.